100% I resonate with when you invest your money in your first deal. What do you think eventually got you over that line? And how did you pick which fund to go into? Were you looking for cash flow? Were you looking for equity growth? Was it just like, I want to get in my first deal?
For me, I was trying to, I knew that I needed, because of the uncertainty and the discomfort I felt while trying to make that decision, I knew I had some growing to do, right? For me, I ended up choosing the income fund, which was, a slow return over time, but a longer haul. I wanted to condition myself with just a $50,000, first investment. I'm like, this will make me comfortable for the next ones, for the future.
All right, welcome to another episode of the Legacy Wealth Podcast, where we help accredited business owners become educated and get access to private investments at the wealthiest investors in the world to utilize to grow their net worth. We do that by providing insight and access to successful fund managers and investors across multiple asset classes. And I'm your host, Pascal Wagner, and today we're interviewing Chad Corbett, the CEO of Magnum Opus Project. Welcome.
Thanks for having me, man. I'm looking forward to this.
Yeah, man. So Chad and I know each other from GoBundance for a couple of years, which is a men's group, a mastermind group to help each other get better in all areas of life. But Chad, please just start out by giving us a story about how you got into investing in funds, syndications, anything where there's an operator managing capital on your behalf.
For me, it started by learning the difference between investments and jobs. And I built companies thinking they were investments, and they turned out to be jobs. And I built a real estate portfolio because that was supposed to be passive income. What I learned is that my lifestyle is what I'd say the dominant reason for me becoming a truly passive investor was lifestyle goal. So I set a goal to retire by 40, and I wanted to travel the world on adventure motorcycles and develop clean water throughout the world. So running a real estate team, doing over 100 deals a year, like a small team, doing over 100 deals a year and doing another 50 or 60 on the investments front, you kind of have a localized business. You're not very geographically independent. So I started to look, as I learned more about investing, I started to pay more attention to taxes and what you actually lose when you flip a house, like how much of that is being eroded. Or you just end up playing this game where the tax deferral game that, swap till you drop, and you're always running from it. To me, it just felt like a giant snowball of liability. And I didn't like that. And I'm like, how can I invest to get, and the yield that I set for myself was a goal of if it won't yield a true 18% ROI, then don't do it annualized. And that's, that was pretty easy to do flipping houses. It was pretty easy to do with workforce housing rentals, with lease options, with sub twos. Yeah, and, wholesale is technically, I guess, an infinite ROI, but those were very, very people intensive. Like you had to be on the phones, you had to go to appointments, you had to know what your competitors were doing. And it just didn't seem like it would actually scale to where I could be out of the country for 2 or 3 months without cell service and come back without damage being done. So for me, it was in large part a lifestyle move. I said, how can I get 18% plus returns and not have to think about it when I'm, trying to survive in the middle of Nepal when it's 115 degrees and there's a snow leopard outside my tent. And that was kind of how I started in this. So the first step there was turning a business into $1 million balance sheet. So I used small business, mainly a real estate team, a real estate education company, and a real estate lead company, and a holding company. Those are all the pieces, like the multiple income streams that got me to where I could, confidently put $1 million on a balance sheet for a subscription agreement. The very first investment that I made, a friend of mine, Paul Moore, who you've probably heard on Bigger Pockets, Paul and I would meet we had like a little 2-person mastermind. We'd meet once a week and have coffee and just talk things through. And he had just finished writing his multifamily book. It was already kind of the back end of that trend before people started paying crazy 3-cap prices. But Paul had already raised capital for multifamily investments, and he just said, in good conscience, I can't put my guys in these deals. So we talked that through, and we back tested different asset classes. And I'm not taking credit for his fund. It was his idea. I just kind of helped, validate it for him. But I watched him put together a fund in 2018. His first fund was focused on mobile home park and self-storage. And we back tested that all the way through '01, and it looked like it would hold up. Multifamily looked like it was overbought. And boy, do we not know what we didn't know, right? But it was hard to find what we considered a really good deal that you'd stake your reputation on, even all the way back then. So that was my first fund. I went into his Wellings Income Fund 1. I think it was income, and he had two. He launched a growth fund and an income fund. So anyways, I went on that. It was, if I remember right, a $50,000 minimum with a bonus 10 pref for first round investors and a projected multiple of 2.4 at the time, with a 3 to 5 year principal payback and a 7 to 10 year disposition were the terms of that. And I chickened out and I went 50 grand. I invested the minimum. And it's one of those things. It was my first accredited investment. It's the first time I'd ever, given up control. That was the hard part. Like it's nothing to just go throw 50 grand down on a house, because you've got options. You can drive over there and do X, Y, or Z with it. And it felt so much different the first time. But here we are, several years into that. The multiple of 2.4 seems laughable when REITs approach you and buy assets at 2.5 and 3 caps. You're just like, what? Sure. Can we close now? I'll NFT this thing so we can transfer it immediately. But so it's actually outperformed expectations. And, for me, I went from a point of being afraid to let go of 50,000 to having Paul come to me and saying, hey, we just sold this for a crazy price. And I'm like, I don't want my money back. Before you ask, I do not want my money back, because for me, I saw it as a way, like if I can keep that deployed there, then I'm not playing the tax deferral game or trying to reallocate. So that was my first deal. It was with somebody I had already built trust with over time, somebody who I knew his story. I got to meet with him face to face. And one thing that I truly respect about Paul is, even though we were our close friends, when I got apprehensive and I'm like, man, I don't know which fund to do, I don't know what dollar amount, he didn't close at all. He said, listen, if you're unclear at all, just don't do this. He said, if you're not 100% clear, I don't want you to invest. And I respected that a lot. And that's ultimately what I've learned through this journey is I underwrote the first one correctly. People first, then the deal. And that's been probably the best lesson that I was fortunate enough to learn in the very beginning of the very first deal is underwriting people. So that was the beginning of my journey. I've done quite a bit since, but that was the first one.
Yeah, a ton to unpack there. I'm excited to dive into it. So tell me a little bit more about, 100% I resonate with when you invest your money in your first deal. It's like, okay, I'm aware that I'm not going to see this money for a while. Hopefully this turns out okay. The first time you do anything, it's really scary. What do you think eventually got you over that line? And how did you pick which fund to go into? Were you looking for cash flow? Were you looking for equity growth? Was it just like, I want to get in my first deal?
For me, I was trying to, I knew that I needed, because of the uncertainty and the discomfort I felt while trying to make that decision, I knew I had some growing to do, right? For me, I ended up choosing the income fund, which was, a slow return over time, but a longer haul. And I wanted to condition myself with just a $50,000, first investment. I'm like, this will make me comfortable for the next ones, for the future. And, in retrospect, I probably, if I had it to do over again, I would have done no less than 100 because it's been a deal that's, I mean, where do you get a 10 pref with what's probably going to end up being a 3.5, 4 multiple? Like that's a pretty rare one with less than a 50% or less than a 35% debt ratio. Like it's almost unheard of. They're out there, but it was a unicorn. And I just didn't know it. I should have been way more comfortable than I was, but I ended up choosing that because it forced me to have a long mindset, the 7 to 10 year mindset. And it forced me to make that connection of you're letting go of this money, forget about it. Like you made an informed decision, you underwrote the deal, now move on. That's what passive means. And I don't think I made any mistakes in that. I think it did do what I intended to do. It's funny to watch as you age. I'm only 41, but I've watched my risk tolerance go from, I came out of poverty, great people, just not a lot of money. And I went from like clinging to every dollar to now it's like, I have to negotiate with the bank because they have these limits where they're like, nobody wires $500,000 in a day. And I'm like, yeah, they do. And it's like, I've sent 7-figure wires and just didn't bat an eye. Like I just dropped into a Kinko's or something and, overnighted a package to make $1 million investment. And not always on my behalf, not always my money, but I represent others. And it's interesting to see in yourself how your risk tolerance or the seeing certain things that you used to perceive as threats are just administrative at this point. And that's what that was about. Like the biggest part of that, the resistance on the front end of that investment was knowing that I had to condition myself to have more trust in myself, frankly. Like I had kind of laid out a thesis. I, did what I thought I should do to underwrite the person, then the deal. And it just came down to learning to trust myself at the end.
How did you even pick funds to begin with? Okay. So you knew Paul and like this investment opportunity came up, but you've had a ton of, I guess, opportunities to maybe invest in your own business or invest in maybe your own real estate or deals. Like, why not the stock market, or why not, why funds? Why not your own investments? Or, tell me about that.
So for me, I came up like in the 2008, 9, 10 period, I was in resort real estate development and sales. So ski front, beachfront. And when banks pulled all the condo products in the early summer of 2008, I knew I didn't have a good enough financial education to understand what was happening, but I wasn't stupid either. So I went to community banks and raised $42 million in 2 days. Then I went to the developer and said, hey, I'm transitioning out of sales. I'm going to help navigate this crisis. So I ended up managing the closings for over $1 billion worth of pre-sold real estate with no lending behind it. And we would negotiate one tranche at a time from banks when they were in a liquidity crisis. And then I would kind of be the hub between the developer, the broker, the escrow, and the buyer. And I would try to find a way to put deals together. And in that, it ended up becoming like a real life Think and Grow Rich. So I got to help over 400 high net worth and ultra high net worth individuals in one of their darkest hours when they were used to running off credit, but their credit was frozen. They were illiquid with, they had an $18, $20 million balance sheet and literally didn't know how they were going to buy groceries. And I got that experience, I think, probably shaped me as an investor, because I saw the ugly side of leverage first. Like I was just starting to build my financial education in that deleveraging event. And I saw deleveraging in its ugliest form, and grown men crying who had so much of their self-worth wrapped up in their net worth. And I think that really shaped who I am as a man, but also who I am as an investor. So coming out of that and becoming an entrepreneur, starting real estate businesses, and seeing myself being more like them, I learned my first golden cage lesson. And, the golden cage is when you're breaking 6 figures in revenue and the outside world's like, that guy's a stud, like he's killing it. And then you realize you worked an 18-hour day and you really haven't lived in weeks or months. So I've made those mistakes. And that in part started to shape that too. When real estate's hard. Like if you're a solopreneur, whether it's investment or brokerage, you have to bust your ass to make real money. Like it's extremely hard. I own real estate course companies, and I try to make it sound simple enough that people aren't intimidated from trying, but I don't lie. Like it takes no lack of tenacity. Learning that lesson, just how hard it, develop ski front, beachfront development. I basically snowboarded, scuba dove, and made buddies with high net worth people. It's a whole different ball game when you're dealing with single family or multifamily. So I learned that hard lesson, and I was like, my gosh, this doesn't scale. Like unless you get, and I see how hard it is for people to build a true autonomous business in real estate investment, like in residential investment or brokerage. It's almost impossible to have something be truly autonomous in a sustainable manner. So I started to lose hope in that vision, and I started to look at, well, what could I do? Like I have this financial education now. I know how to underwrite deals. I've done stuff for clients who are high net worth clients that didn't know a lot about investing. I was able to educate them to make better investment decisions, which just created my next deal, right? So that ended up leading me to an introduction to a guy named Joel Block. And Joel does an annual or biannual syndication symposium in Las Vegas. And I think it was a family office guy that said, you need to meet this guy. So I flew out to Vegas, and I went through I think it was 3 or 4 day, intensive symposium with Joel Block, and learned how to be a sponsor. That to me looked like the biggest golden cage I could ever build. I was really grateful to know exactly how to put an offering together, to know what it looks like to be a sponsor, and to meet sponsors who were trapped in their own deals because they didn't
explain sponsor to the audience.
Just the general partner in a deal. So the person who has all the voting, all of the voting power and all the decision making power that your money is funding. And for me, the risk reward of that, I'm an empath. Like it's really important to me that I don't hurt people or disappoint people. Like I want to make people's lives better. So what I had overlooked in that, I was excited about the finance, the capitalism side of being a sponsor. I hadn't really considered the human side. And when I started to actually meet people who were stuck in deals because of the human aspects, because their reputation was on the line, the return was gone. They were working their asses off to save their reputation. And I'm like, nope, this isn't for me. Like this is even worse than owning a single family or multifamily portfolio. It owns you. And for anyone, I have friends who are probably listening that are sponsors. Like I have nothing but I have the utmost respect for good sponsors. I don't feel like I should be one because I like to earn like a banker and live like a hippie. And if I want to be off grid for a month, I want to be off grid for a month. I don't want to be, thumbing an iPhone looking for a cell signal. So that was my first introduction to funds, was actually looking at getting into the fund as a GP because I had deal flow. What I didn't have was enough buyers to buy all the deals that I could find back then. I underwrote some really neat stuff for other investors in that 2013, 14. The corporate bankruptcies were still happening. There were still some pretty damn interesting deals happening behind the scenes. And I'm like, my gosh, but they were big deals. And, those are past now. It's coming. We're setting up for that again. But that's kind of where I made the switch from having a GP mindset to an LP mindset. And I'm like, wow, nothing but respect for these guys. I'm an investor, not a sponsor. So then I just kind of adjusted, my strategy and thesis. And I'm like, okay, so I know I want to be a passive investor, not active. And I just doubled down. I shut down 3 companies in one day, doubled down on one, focused all my growth and the one that would allow me geographic independence and the quickest growth trajectory for a balance sheet. Doubled down on that, took it into 7 figures, and was able to get that, get my personal balance sheet up. And then I started, just pouring every dollar I could. Like I cut when I first joined GoBundance, we do 1 sheets for anyone who's not in it, which is essentially like your personal financial and lifestyle statement, if you could imagine that all on 1 page. And the first year that I joined, I had spent $50,000. I think I had 503 horizontal, and I'd given away 163, and everyone's like, who the hell are you? But that's how I was thinking. Like, I was spending as little as possible, and just all of it was being pushed into investments so I could get there. So that's how I got into it. And then, once you get into a good deal, it's like, oh, you want more, right? It's like, well, who the hell cares if that house just hit the market? Like, if I can make a 25% IRR and go travel 9 months a year, I could give a damn if every house in the neighborhood is 50 cents on the dollar.
Yeah, totally. And when you started investing, was it for additional cash flow? Were you looking for opportunities that were primarily equity growth focused? Or was it a mix?
No, for me, I learned something, and I thought at that time I was in my early 30s, and I thought I wanted to retire by 40. That was a goal that I set. At 29, I hit the reset button, burnt the boats, disappeared into the wilderness, and came out a different guy. And my goal was retire by 40, go save the world, like go do philanthropy work, do adventure travel, blend all that together with photography, and just have fun. But as I got to where I set a number of 2.25 million invested at a conservative 10% yield, and that would give me, 225 grand. And that was enough to live and give like I wanted to. But when I got there, hedonistic adaptation gets the best of us. It's like, well, this isn't that special. Now what? So I started to think differently. I started to think bigger. And I'm like, well, what if I could give away 20 million bucks before I turn 50 just to see what that feels like? So that in large part has shaped my investment thesis. I look at things in short term, mid-term, long term. And for me at 41 years old, for me at 30 years old, when I first these are my novel thoughts, but I'm sure many people have come to these same conclusions. For me, short term meant in the next 3 years. Midterm it meant in the next 10 years at that time, from 30 to 40, like till that retirement horizon. And then midterm was 40 to 62 until you can access your retirement instruments. And then from there on, that was the long-term bucket, the legacy bucket. So for the beginning of this story, I was investing with that mindset. Like, I want to, between now and 40 years old, this is where you do your high risk, aggressive investments. This is where you learn and take chances. This is the proving ground. The midterm bucket, I did things like Index Universal Life, where I started investing in my early 30s. So I know I could self-bank in my 40s. And I have contingency plans for long-term care, disability, chronic illness. I've got all those riders attached. It's even, I can use it in such a way that I can give myself 0% interest loans for acquisitions. I can treat it like a cash instrument, or I can loan myself money at ridiculous commercial rates, and I can harvest off tax liabilities into a non-taxable entity. So if I want to make an investment personally or through an LLC, then my IUL can lend my dead Chad's money to this at, like, let's say 30%, and I can make 30% returns and pull that profit out of the company and into the IUL. So that was my midterm mindset, was things that aren't necessarily that risky, but it takes time for them to mature into where they become really usable. So I started to invest in my 30s for an instrument that I still don't use in my 40s. Now we're coming into the environment where it seems really smart that I set that up, because I'm still paying premiums based on my 30-year-old self. But now my 41-year-old self has $1 million in liquidity at zero interest or stupid high interest rates, depending on what the strategy is. And who the hell wants to pay 8.25% for a deal? Like, if you do want to use leverage in this correction, so it's that, I'm pat myself on the back a little bit there, because everyone told me I was a fool, but it's turned out to be really good. It was smart to do. And it only represents a percentage of it. It's not my primary investment vehicle, but I guess I'm mostly showing you my mindset at the time is like that is just, it's a 18 grand a year goes into that in premium, but it represents a whole new set of opportunities in my 40s and 50s. And I started to fund the investment in my 30s. So you don't see a great return on that. I mean, it's probably returned, 8 or 9%. tax-free though. And as time goes on, it's almost like an amortization table. The fees are heavy on the front and then almost taper off to nothing as it becomes fully funded. So that was the midterm. And then long term, I was using self-directed IRAs with checkbook control, solo Ks, and SEP IRAs. And that's a bit of a game, like the deferral game. I ended up changing all that. And as the political climate shifted this last time and I saw goalposts being prepared to be moved, I ended up restating all that into a QRP. But at that time, my long-term bucket was hard money lending on a small scale. I guess I would call it just private money lending. But I did really well with that. So my long-term bucket, I would write to local real estate investors. I would originate at 1%, 15% interest unless the loan goes out of term, at which point it retroactively adjusts to 18% interest from the point of origination. And with that, I would average about 19% APY in a self-directed IRA. And I mean, do the math. Your money doubles every 3.65 years, right? If you're doing that. So that was kind of a game. Like the long-term bucket is kind of my the education department, right? That's where you're like, okay, so if I have to make a mistake, I want to make it in the long-term bucket. The short-term bucket is, it's aggressive. You find out if you're wrong faster in that bucket. So I kind of looked at it that way. And then once I had that established, so I was focused on income growth in my own companies, which would give me investment capital. I was focused on getting my taxes as low as I possibly could, all above board, but without building myself another golden cage. So I became a Florida resident. I started learning. I learned a lot more about how to properly use LLCs with S Corp elections. Like how I received money became very different. So and I've been able to keep my effective tax rate below 20% for years. I think it was 12.8 in this last year. It was kind of focus on growing your income, then focus on minimizing your taxes, then focus on, having some investments in those buckets. And then you're like, okay, now what? And that's where like passive, LP positions were just the most logical thing for me. You can go buy a small business. You can go start another small business. You can go buy real estate. There's a million things you can do. To me, stocks, I look at stocks as the same as stock investing. To me is like investing in real estate by only looking at Zillow for sale by owners. The deal has been picked over thousands of times. And I know there's obviously exceptions, like look at Buffett and Munger. But as a basket, I think we have an index fund bubble right now because too many people trust passive investing in equities. And, I respect Jack Bogle, but I do think that like what he said in the 80s isn't the same now. We've slowly built this confirmation bias chamber of Facebook groups and blog movements that have turned into an everything bubble. And we're going to see a lot of those passive investors that are trying to live on a 4% rule. They're in for a pretty rough decade, I think. So I looked at that. I looked at Mr. Money Mustache and, all these different FIRE people, the financial independence, retire early. And that to me looked more dangerous than the buy multifamily, rents always go up, confirmation bias chambers. And I'm like, yep, that's not it. So I started to look at stock. I did look at stocks. You look at stocks, you look at bonds, you look at real estate, you look at gold. At the time, crypto wasn't that exciting. We were all still, I think at that point, still learning about it. I go back to emails between me and buddies in 2013, and I'm like, I can't even read this. Because we were like, if we just put 10,000 on it, this would be a way different conversation had we had the courage to do that. But ultimately where I ended up was I like real estate. I like certain silos of certain verticals in real estate. And that 2016 made me very nervous. Like when the Federal Reserve tried to taper from 2008's, QE, their intervention, when they tried to taper and we had taper tantrums, in fall of 2019, when the repo market, breaks down overnight just because you're trying to taper the Fed balance sheet, I didn't trust many things. And I like real estate, but I don't really trust the markets in real estate that are purely driven by falsely low interest rates. rates, what goes up has to come down. And if rates stayed at zero forever, that would have been fine, but I didn't think they would. So I was looking for what is the recession-proof vertical in real estate? What is that? And it's, the lower 30th percent obviously get hurt the most in these type of monetary environments. But they also they have to consume the highest percentage of income. And that's where workforce housing, self-storage, mobile home parks, things like that are, wise real estate investments, grocery stores, discount stores. But most of the things that I looked at then were already looking overbought to me. I mean, how many Dollar Generals have been built in the last 8 years? Like, that was a really attractive investment back then in like 2013, 14. I was like, I wish I was in a position to do this, but I wasn't. And now it's like, who would do a Dollar General? You have to build 14 of them to make any sense of it now. So that's what landed me into like the LP mindset. What ultimately landed me back in the real estate vertical, and looking for that first deal. I looked at buying my own mobile home park, or I actually had an idea to lease land dirt cheap, throw up a chain link fence, put in, 150 tons of gravel, and go to the port in Norfolk, Virginia, and buy wholesale connexes, bring them back and make a modular self-storage. The reason I got to that is as I underwrote my first couple self-storage deals, I realized the biggest risk you have, and the one that's hardest to control, is someone else building one across the street or just down the road or closer to an intersection. And I was like, well, you can mitigate that risk. Just make your self-storage portable. So why don't we do connexes? Just cut garage doors in them, frame walls. And in a matter of 3 days, you can move your entire facility and just send them a new address. Your stuff's here. So that's what I was looking at doing. And I'm like, that's just too much work. That's where that I was like, earn like a banker, live like a hippie. Nope. That's working like a banker. So I kind of backed off and I was like, okay, how can I invest in this? So Paul and I met for coffee one day and he's like, you're not going to believe I'm completely pivoting. And I'm like, tell me more. And ironically enough, he was pivoting into the space that I was considering jumping into on my own. And I'm like, take my money.
That's awesome. So what I'm hearing from you is this trend of, look, you've built up you had this dream as an entrepreneur to grow your wealth and ultimately kind of live this lifestyle where you could travel the world and do what you wanted. And at some point, you're a deal junkie. You're someone who has access to deals. You have knowledge. You've the expertise. You could do you do all of these things yourself. But you're realizing that in order to achieve the next stage in your life, to have that more freedom, the ultimate goal of what you're trying to pursue is that you need to be more of an LP investor. And then what I'm also hearing is that what you're thinking is, okay, where do I want to place money, in what asset classes, what's happening in the economy? And you're a smart guy, and so you're thinking through like, I think this asset class will do well. This is not overbought yet, or things like that. And then you're finding operators to place your cash with so that you can go live that lifestyle. Does that sound like a good recap?
That's how it started.
So what does that look like? What does your investing look like today? Like, how much have you invested into LP deals? What are maybe the different types of asset classes you've invested into, or is it all mobile home parks?
Yep.
And then how do you pick? Would love more of your thinking of why you went into those and maybe what you're thinking about now.
Sure. So from that first deal, I took the position and I'm like, okay, now I'll rebuild cash, get back to a good cash position, and I'll go find the next one. So I started looking at other syndications. At that point, I got really fixated on the lifestyle goal. So grow business income, grow as quickly as possible, and go have a damn ball. So 2018 and 19 were just fantastic years. I was all over the world. I traveled 9 to 12 months a year. Broke was growing my net worth tremendously, growing cash flow tremendously, started new companies, like had a digital course company. And I was just having a ball. So I got a little distracted from my own thesis. I was just piling cash. And until that come around to, was it like November of 19, I just looked up and I'm like, I had been literally all over the world that year, and I hadn't even thought about investing. I had like 800 grand in cash sitting in freaking checking account or in the money market under $1.5 million FDIC insurance with Edward Jones. But I hadn't even been looking at that. I was just plowing money into that, waiting for a correction, right? Like I'm like, well, the repo market's breaking down when they do simple tapering. So it's about time, like get the cash ready. So I was just stacking cash for, 2 years almost, but I was making a lot, like what I was investing in my companies, the time I invested was resulting in, very high income. So I looked up all of a sudden and I'm like, what the hell is wrong with me? Who sits around with like 800 grand sitting in what was the money market account back then? Like 0.003.
Yeah.
And so I'm like, holy crap, I got to do something with all this money. And I started looking at what do you buy? And I almost went back into multifamily. Because I was in the process of selling my shares in a company, already had more cash than I cared to have and wasn't using it. I'd been busier playing than I had been thinking about investing. Prior to COVID, Nigel and I had $7.3 million worth of multifamily under LOI. We got home from Nashville 2 days later, boom, COVID lockdown. And I'm like, I don't know, man. Like, who knows what this is going to be? So I took the conservative route. I'm like, I'm going to pull back and wait. And I realized it might cost me these deals. And while I was waiting, I was like, I trust, based on the macro conditions at that time, what I saw was an energy crisis. And I started looking for energy arbitrage. And I'm like, what the hell does this even look like? How do you gain control of fuel or, like electricity? Or I'd looked a lot in the solar, like commercial solar development. And I'm like, how do you control electricity? If everyone's going to be home, rates are going to rise. If we're doing all these things economically, we're going to disrupt commodities markets. We're going to disrupt. So how do I get into commodities and energy? And how do I do that as an LP, not by equities, not by stocks or ETFs? Like, how do I get into the wholesale side of energy arbitrage, not the retail side, like if you buy utilities, as an ETF? And that is what ultimately led me to find an opportunity in Bitcoin mining. And I was a first round investor. I found some guys out of Texas that if you remember the day West Texas crude went to minus 35 a barrel, that was a pretty exciting day because we were already talking about this and they took action in a big way. And getting that power purchase agreement at, a sub 2 cent electricity. And what do you do with sub 2 cent electricity and a free substation you don't have to pay for? Well, the best way to convert that into cash, even when Bitcoin was trading at $8,000, was with a Bitcoin mine. So I took a $200,000 position and a $30 million raise. That was probably the most speculative thing I've ever invested in. However, when I looked at the macro environment and I looked at Bitcoin, and you and I were talking about this at that time too, I didn't have the courage to buy Bitcoin because I didn't see the adoption rates where I wanted to see them. I didn't see that the utility, others didn't see the utility of it. And it wasn't understood enough. So I'm like, I want to benefit from what I believe will be, a huge rise in Bitcoin, but I don't want exposure to the Bitcoin itself. So what can I tolerate exposure to? Energy and real estate. And that's how I looked at that deal. It was backed, by energy for the most part, but also backed by a debt instrument, a senior debt instrument. And that one, I went 200 in that. And not no more than I wrote the check. It seems like I think Bitcoin was trading at 12. I discounted it to 8. I was looking at a 25% discount for underwriting. And if you want to get into how we underwrite sponsors, that was an interesting one. But ultimately, Bitcoin went on a tear literally 2 weeks after that. And that one rose to be a unicorn in 8 months? I think we went from 0 to 3 billion independent valuation in 8 months. So that's where LP got really exciting. And that investment's very close to going through a reverse merger. Even throughout the turmoil of the last 18 months, we're still looking to list that company. And that'll be a first for me, like to within a 3-year period, invest in a unicorn with what I would still say is an extreme level of protection, multiple layers of contingency plans, and to have it actually blow into a unicorn and go public. That's been a pretty fun ride. I've learned a ton. I was just on the phone with
you invested in that company as an LP, and it wasn't like a Bitcoin it wasn't a Bitcoin mining fund. It was an investment in the company that does Bitcoin mining.
Yep. And the assets, the assets were, a power purchase agreement. That was a 10-year power purchase agreement. It included it was only a $1 lease, but it was in an industrial brown space that was condemned by the EPA, but had all the electrical infrastructure already in place. And we're talking $150 million in substation infrastructure that we didn't have to raise capital for. So there were risks in the deal. Like, what if the EPA says, nope, we want that back? What if, ERCOT, reneges on their deal and cuts the power? There was a lot of risk we really had no control over, that was again, like I had conditioned myself to have more risk tolerance. So for me, it was the people were the biggest part of that deal. Like, who are they? What have they done in the past? What do they do if all this goes sideways? And what I loved about that deal is they had not just one, but multiple contingency plans. You can just sell the electricity. You can convert the building into a server farm. You can do many different things. But in addition to having contingency plans to the primary strategy of the company, they were giving us senior creditor positions. So we didn't have voting rights, but we had control if it went sideways. And I found that, I think that was, I think in retrospect, like, those guys should really document what's happened with this deal over 6 rounds, all having a different type of, debt equity instruments. It was very investor focused. Like, they've along the way have continued to, if something changes, which boy, has it changed a lot recently, like, they will get creative and actually offer, kind of a bonus to investors for trusting them while they weathered the storm. So that deal, there's a huge returns in it, but I think the biggest takeaway from that deal is it's the validation that really focusing on underwriting people is critical. That's what matters more than anything.
So dive into that a little bit more. So, we've talked, you mentioned at the beginning, it's actually just a common theme on this show of investing in the operator first, the deal second. How do you go? One thing that I keep hearing is when you keep talking about the operator, which I want to get into here now, but you've also talked about a lot about how to de-risk the deal. So maybe what I'm hearing here is you have a 2-step process. The first is you underwrite the operator, make sure that you feel comfortable. And then the second part is like, okay, everything about this deal, what are all the risks and how is it being de-risked? And then am I comfortable taking those risks? Is that what I'm understanding?
Yeah. Yep. And in that first part of it, like the thing for me is I want to look a guy in the eye and say, what happens when this gets sideways? When you're working 7 days a week to defend my principal with no chance of return and you're not getting paid, how many years can you tolerate that?
How do you do that? Like, okay, I'm imagining Chad walks into a bar, talks to this guy, and is
you just do it the way I do.
Like
you let awkward silence hang, and you watch body language. You listen to answers.
So you're literally asking that question.
Oh, hell yeah!
Yeah, so give me like the answers.
They're all different. Like, that's just the thing. You can tell silence, like awkward silence, I find to be one of the best tools in business. So if you can say something abrupt that the other party didn't expect, then you get them. They're not, and that you break them out of their patterns. You put them in their prefrontal cortex, and you get the real answer. And the more rapid you do that, and the more awkward the silence is following that, the more authentic the answer usually is. So if a guy's going to squirm like Nate from, I wish I had a recording of that first call. I was like, this guy's going to hate me because I was trying to flush out any inauthenticity. And we're friends. It didn't cost me the relationship because he got through it. He was who I was hoping he was, but I was pretty tough on him. Like I was very crass, and I'm not that way in real life. I'm not that way, in business, but there's a lot. I don't really want to put a percentage to it. Just be damn careful, because a lot of sponsors, like a lot of GPs, like it's all great when it's a pro forma. But what you have to underwrite is what happens when that pro forma proves to be wrong. And is he going to work 20 hours a day, mortgage his damn house, and know that he gets zero salary and zero return on the deal? But will he do that to defend your capital? And if the answer is no, go find one that will. They're hard to find, but they're worth the work.
How do you? I mean, I'm just trying to picture you asking, each GP this question. And
they're all different. Like there was one here recently that it didn't go well. And because and it wasn't nearly as aggressive as what I just showed you, but they were claiming to have artificial intelligence. And I'm like, oh, that's great. I mean, like, so you've got true machine learning algorithms and language models. Oh yeah. I'm like, cool. Pull up your screen. Let's demo. Oh, well, I'm like, all right, well, send me the NDA. Let's do that. And, go ahead and send a subscription agreement. Hell, I'll sign it. But I want to see I want to see what you're building. Well, he immediately got defensive. So I just turned the heat up a little bit. Well, come to find out, they're not even fucking writing code. They had $20 million of other people's money paying fat salaries, bragging about their last exit. They don't have anything. ChatGPT will destroy those guys because they're claiming to have an AI-driven robo-coach and act like it's a damn, virtual Tony Robbins, but they have an idea. And just by barely leaning on them, they got defensive. They showed me that early. And that I would never, and I was that direct. I said, I don't trust you. I would never place $1 of my worst enemy's money with you. You will screw your investors. And that didn't go over too well either. But like, I don't mind having that reputation as an underwriter. Like, I want sponsors to respect me. But if it's a sponsor that's doing that to people, I want him to be aware of me, and I want him to tell his friends about it, because that way they won't end up on my calendar, right?
Totally. Is this process methodical for you? Do you have like a checklist? Is it like I ask these 10 questions? It's
an intuitive thing. No different than it's like building friendships, honestly. Like it's really, is this a person that I want to share my most limited scarce resource with? When you meet a guy, it's easy to get excited especially conventions are good for this, right? Everybody's juiced and there to connect. And it's like, one of the things I ask myself is, obviously time is our most precious resource. Is this human someone that I want to share my most precious resource with? And can I add value to his life? Like, can I, make it worth his time? And it's not that much different with sponsors. Like, is this someone that, you're probably your second most precious resource, just because it can help you with all areas of life, is money? And is this someone that I trust no matter what to invest this precious resource with? So it's intuitive, no different than like learning who you can trust in your personal life and in the course of everyday business. It's kind of the same thing, not rocket science.
Yeah. And then when you get into deals, I mean, I'm hearing you listing off like, oh, there was this risk of the EPA being able to pull back their contract, or, do you have a pool of people that you talk to, or you've just been in this game long enough to where you're like, how do things go sideways?
Yeah, I talk to people. So ultimately where I've ended up is I've ended up investing with to allow friends into investments that they didn't have access to. I sent a text message and I don't know, I was out in Washington, near Leavenworth, Washington, out in the National Forest, living in a camper, and just thought, oh, why not start an investment club? So there was a safe round, an investment that was coming up as a safe round. So I sent a text message to 12 friends and I said, hey, I've got this opportunity that really the public doesn't have access to. You guys all think I'm a drug dealer. Like this is the kind of stuff that I invest in. Are you interested? And 10 of them jumped. And so within 5 days, I went from not knowing what an investment club was to owning one. So I pulled together the operating agreement, the procedures, I used TribeVest as the platform, the communication hub and banking. And all that came together in 5 days in the middle of the National Forest in remote Washington. I learned a ton in 5 days. But what I've ultimately learned, I thought it was going to be a single purpose thing. I'm like, all right, I'll let them ride my coattails through this one, then we'll just burn this once we're liquid. And what ended up happening is I realized in that my closest circle of friends, they're developers. They work for, large companies. We've built ski front, beach front, luxury, single family, multifamily, highways, cabins in the Smoky Mountains, water parks. So, but mostly small business and real estate income, but they have never even heard of these types of investments. So one text message kind of changed my whole perspective on things and how I underwrite. I'm not their fiduciary. I'm a GP, they're a GP. But I feel like they're fiduciary because I got them into this and, beside of my name, it says president. So it's really changed how important it's made underwriting even more important for me, because imagine if you make a bad investment decision and drag your 11 best friends into it with you. That sucks, right?
Oh, yeah.
So that's where a lot of this comes from, is like trying to help other people into this has really changed how I look at deals. And that's why I'm willing to be even more crass earlier in the conversation. Because if you got to talk to, to me, it's probably 100 to 1. I can look at 100 decks and I might find one that I'd be like, yeah, I'd invest in that. I'd do that deal. Since fall of 21, I've been underwriting, through a different lens. Like I look at it with even more scrutiny now, because I'm not just protecting myself, I'm protecting my friends, but my reputation with those people. So I've gotten probably a little more critical of things. I met somebody so I'm in Genius Network, and I met a gentleman in there he's an advisor to ultra high net worth business owners. And I've never seen anyone do this before, but what he does, he has a process that takes upwards of 6 months. The sponsor has to pay all the cost between $200,000 and $250,000 to be fully underwritten and investigated. So what they're doing is they're getting CPA firms to go in and dig into every business they own. They ask them for a personal financial statement, including all businesses and everything. So they're looking into all of their businesses. They're doing background checks, credit checks, like on all of the principals in those entities. Then they're digging into their personal finances. They're digging into their personal lives. Like they are uncovering every stone. But when they put somebody on a Zoom call, they have been vetted for over a 6-month period, and they're $250,000 invested just to get on a Zoom call. But to us, very, very small firm with 2 partners has $731 million AUM. Wonder why? Because they can get their guys into 3x, 4x deals in a 2 to 3 year period, because they're really scrutinizing, and the good sponsors, the cream rises to the top. Like they have access to the no bullshit guys that won't quit. They'll make it work, and they've got, multiple ways to do that. And that's probably the most formal underwriting that I've ever seen on a sponsor. But I think that's absolutely brilliant. Like he's a, a trusted advisor. Like, how many of you guys listening, how many of your financial advisors would even like spend $5 to take somebody for a cup of coffee to see it? Like, like they're very commission driven. And unless it's a retirement account, they're not even or they're an RIA, they're not even a fiduciary. And this guy's willing to put this huge hurdle in front of his firm that says, yeah, we can greatly benefit from raising capital for you. But before we raise capital for you, who the hell are you? And here's our process. It's going to cost you $250,000 in 6 months. If a sponsor is willing to go through that, they're going to be with you for the long haul, right? A lot of people, the ones that make me most nervous are the ones that are trying to raise capital within 90 days of the start date of the project. It's their first deal they've ever done, and they have no contingency plans. And and the more risks that are disclosed in a PPM or a private placement memorandum, the scarier that document is, the more I trust the principals, because they're willing to put that out there.
Totally. To kind of like maybe wrap this up, how has your perspective on investing changed since you first started investing in funds to now? Like, what lessons have you learned? What maybe have you adjusted in your process?
Lessons learned is 99% of deals aren't deals for me. If you're going to take an 8 pref and a 1.5 multiple on an 80-20 split over 10 years, good for you. It's probably safer than stock investing. But to me, that's just that's retail shopping. So I'm looking for what most people would perceive as really risky investments, but I'm looking for more upside. I mean, you and I both have money. Like, we know funds where you can get 12% with literally next day liquidity on a 12 pref. Like, why buy those other deals when you can do that? And you can trust those guys. Like, we know them, right? Like, they're really good people. So I think I see a lot of people just buy into these deals because they don't know what else is out there. And there's some really amazing funds out there. You just have to, and that's the thing. Like with Don, everyone knows he won't quit, right? Like it's not too big to fail, but the culture within that organization, they won't quit. Like, they'll figure it out. They'll pivot. They'll innovate. If the market shifts, like, they're not going to quit. They're just not in them.
And there's a real business behind that opportunity.
Yeah,
I just made an investment in their fund today, actually.
Yeah. So like that one's awesome. That's one that, like, it's hard to compare a lot. I mean, it's hard to compare much to it. So for me, I've gotten more picky. I've learned to better underwrite the people, to find which people are going to end up putting the best deals in front of you. And like with that sponsor we were talking about, I don't know if we're naming names, but like, they offer a variety. So whether you're looking for, income with liquidity, or whether you're looking for long-term growth with tax favorability, they pretty much have it there. So when they give you options, like when a sponsor gets to the point where they're like, okay, you can have the red pill or the blue pill. We don't care which. Oh, hell, we don't care if you take either. Like, that's when you're in the right room. Like, you're talking to the right people when you start to hear things like that. Like, we have options for you. We don't care if you invest or not. Then you're on the right track. And that's what I've learned. So I've kind of raised, and I guess it wasn't an accident. I guess I was just right from the beginning. I have nothing but respect for Paul Moore. I think he's outperformed my and probably every investor's expectations. I somehow got that right in the beginning. I'm very thankful. I don't have any horror stories about this. My hackle went up and I got out before I ever got in on a lot of those, like the ones that were marginal, and I've seen them go sideways too. And I'm like, whew, dodged a bullet on that one. But that's the biggest thing, is like just figuring out, and you're inspiring, like your thesis, like literally sitting down and taking the emotion out of investing by having a written thesis, I think is an amazing thing to do. And you've shared yours with me before. I've seen it. And I think that everyone should do that. I don't really know anyone other than you and I that do it. But when you do it, I'm like, oh, he's as big as a geek as I am. Because like I have a spreadsheet with allocations where I am now, where I want to be on a percentage basis, just formulas, and it rolls my entire net worth, and it shows me where I'm off balance. And it just is a simple spreadsheet. But I think having a thesis, having deliberately investing is really important. That helps you not be subject to your own cognitive biases in times like right now, when, who the hell knows what's happening right now. It'll be months before we actually reveal the truth. But I mean, just with what's happened with SVB, go back 2 weeks ago. Did you think it would play out this way? No one had a freaking chance of guessing what would happen. My bank ended up buying up SVB's assets, 2 days ago. And I was freaking out, digging through their balance sheet. I'm like, should I move to other assets? And then hell, my bank ended up buying SVB. Didn't see that coming. The exact opposite. But I ended up holding my position because they were healthy. But you never know what's going to happen. And I think that these next 10 years, and I'm sure every generation has had a chance to say this, but these next 10 years sure seem like they're going to be more interesting than any 10 years previous in U.S. economics, just because of we've been slowly transitioning from an agrarian society to an industrial society, now into an information society. Mr. Moore's Law, he just passed away 2 days ago. It's so disappointing because he was just about to see Moore's Law get to the point of proving it was right. But he got to see a lot of interesting things. But I think you're going to see more and I'll put this in air quotes for anyone who's not watching video, opportunities are going to be your biggest risk in this and the economy we're emerging into, because with AI, you're going to have more deception, more possibility for deception and misinformation than you've ever seen in your life. You're going to have tools that are doing underwriting work for you or for other people. And for me, I build my own damn spreadsheets. If somebody sends me a pro forma, I'm like, yeah, that's great. Delete, start from the beginning. Because in my head, if I don't have a cognitive map of the formulas, I don't trust it. So when ChatGPT-4 fires out a pro forma for a multifamily investment and runs 3 different scenarios, are you going to go through every single cell and prove that ChatGPT's work was accurate? Because we know through psychological testing, it's about 9.5 years old in human terms. So are you going to invest 7 figures of money on the advice of a 9-year-old? Probably not. So I think the way we underwrite it's going to force us to innovate. I think that it's going to be easier to be taken advantage of in this new economy than it ever has been. It's going to be easier to create big, beautiful decks and amazing pro formas and financial models with literally text prompts. People don't have to learn how to use Excel. I think it's the really, really good sponsors are probably going to be more back of the napkin than they've ever been. And the shysters are going to have beautiful pitch decks and amazing pro formas and a lot of things like that. So I think we're going to have to be even more prudent as technology increases. And that also affects the other asset classes that we're investing in. I think it's going to get really interesting, but you better watch your assets more than ever, because it's going to be easy to be taken advantage of. And there's going to be a lot of desperate people out there they've been high on debt for, most of their investing career. And that's breaking down and they're losing access to it. So be more diligent than ever when investing with somebody for the first time, because their legal documents protect them if they can just get the cash. So just make sure that if you're not sure, find a mentor in this. And I can't remember the author's name, but there's a book that was written in the last couple of years I wish would have been there when I started. And it's called, Hands Off Investor. I cannot remember the author's name, but if you made it this far in this conversation and you haven't read Hands Off Investor and you haven't yet done an LP deal, go buy that book, because he took what took me a decade to really learn, and he sells it to you for $15. That book's worth $100,000 to anyone on here. If you were going to play in this space, that book is worth $100,000 to you. I have no association with it. I'm glad somebody finally wrote it. Because I spent thousands of dollars going to conventions to sit in rooms for 3 and 4 days to learn it. And what he says in that book is really consistent with this conversation. I was surprised. I was like, ooh, what am I going to learn? What have I been doing wrong? And he's kind of the same thing. Underwrite to people, then look at the deal. But he'll explain to you in very simple terms what this looks like from an absolute beginner standpoint and what the inner workings of a deal look like on the GP side. Even though you're looking at being the LP, you should understand what their role as a GP is and what's important to look for in them. But I am looking for opportunities now. I think there's all that said. I think the technology is going to bring some interesting opportunities. I think big pharma better look out because we've got psychedelics in late stage clinical trials. And I think there's going to be some really interesting opportunities in triple net real estate in that space. I think you're going to see some really interesting opportunities in the advancements in neuroscience and wearable devices. I think there's some really interesting plays that are emerging there. And I think you're going to see some very interesting energy and commodity arbitrage opportunities. And, like I would suggest anyone listening to this, like, if Pascal hasn't talked about, the way he establishes a thesis to make his investing less emotional, I think you should talk about that and show them like why and how. But you should do that on your own, even if it's like, all right, I've got X amount and I'm going to allocate that into these two different asset classes. And here's why I chose those two. And here's how much I'm going to put in each one. And here's how long I expect the money to not be in my control. By doing that, when things get emotional, when stuff goes sideways, when you have a small window of opportunity to make a deal, you won't get hung up in fear. You'll know, listen, I trust myself here because I have a thesis. It was carefully established. And all I have to do now is make sure it's the right person, the right deal. I don't have to deal with my own emotions. We've already cleared that hurdle. So that's what I would say is your largest step in preparation. Get yourself educated to a point where you understand the vehicle we're talking about. You understand how a Reg D offering works. You understand the difference between Reg A and Reg D and where you fit in that. And does Reg A fit into, maybe some of those opportunities fit into your thesis. But get all that out of the way first, then start looking for deals or start looking for sponsors and start looking at their deals.
Yeah, and one of the benefits of even writing an investment thesis is being able to look back and understand what were you thinking.
Yeah.
And then iterate like, oh, I thought this was happening and I was totally wrong.
Yep.
And I think that's where most of the learning comes from. But
it's humbling, like, because after God knows how many thousands of hours of research in 2016, and I remember someone else that was doing the same thing. Like, it was very validating for me when Ken McElroy started to dump a large chunk of his portfolio around the same time. And I'm like, see, I'm not crazy. And we were both, talk about a Michael Burry moment. Like, hell, we were 5 years early. But who knew that we were going to print $4 trillion and throw another 2 on the balance sheet, right? Like, who the hell knew? And before we even did that, slam rates to zero. Like, had that not been done, I mean, the rates went to zero in a hurry because they knew what the heck was going on. We learned that back in the fall of 19. So anyways, who the hell knew? But it's interesting to go back. And I made a video in I had a real estate lead company the first week of COVID lockdown. And I was like, God, everything I said in that was wrong. I went back and listened to it a few months ago. And everything wasn't wrong. And I actually did preface it. I said, all of my opinions are all subject to be wrong and to change based on what quantitative easing looks like and how much of it there is. This could be pushed out 4 to 6 years. And damn, I was actually right. But I went back and listened to that, and I still think all that's happening. Like, it's just happening way more slowly this time than it has in the past. And it's every time it's different, and it always looks simple in retrospect. expect. But in that, like, one of the exciting things, if you're just getting into this, congrats, first of all, for making it to accredited investor status. Also, congrats on being at the right part of the business cycle to ride the wave up. And most likely the right part, it's not going to feel right for a couple of years, but being in the right part of the monetary cycle, the long-term debt cycle, because this is our great grandparents' moment. I think the world will come out of this looking a lot different than it has in the past.
Thank you for coming on the show, Chad. This was awesome. And I'm looking forward to talking to you again at one of the next GoBundance events. Yeah.
Well, thanks for having me. If anyone wants to reach out to me, I should have said that. I'm on Facebook, Chad Corbett, or you can email me, chad@magnumopusproject.com.
Sweet. And I'll include all the links in the bios as well. So,
okay.
Thank you, everyone.